Okay, we are going to start. I think that you guys can see Excel file, right? Yeah. So this is provisions, contingent assets, and contingent liabilities. It's a very, very, very important standard. Uh, you can see the standard appearing in many different. I mean, I can't imagine any financial reporting exam at any level and which does not somehow include provision, because whether it is consolidation, somehow IAS 37 finds its way to fit in a consolidation question. Whether you are talking about IAS 16 PPE, it may come in. Borrowing cost, it can come in. Intangible assets, it can mix up. So it mixes up with many different topics. So it's about IAS 37 provisions, contingent assets, and contingent liabilities. The areas which I need to cover are, number one, basics of provision, which is actually, I would say that, at a fundamental introduction to financial accounting level thing. What is a provision? What is a contingent liability? How do we differentiate that? Basics of provision, I need to calculate, I need to explain. Then what is important for us is provisions for restructuring. We will discuss. This is slightly advanced type of thing. Then we will have, provision, and then, calculation and accounting treatment. And then last part, which is not part of many times your exam, but I will explain you separately, that inflation adjustment in provision, how we do that. So this is something I would say extra or bonus, but more, I mean, a little bit slightly more than the scope. I'll go slightly above. So first of all, basics of provision. What is a provision? Provision is actually, it's a kind of a liability. So in business, you have liabilities and you have uncertain liabilities. So the topic starts with uncertain liability. A liability is something when you receive a document, you receive an invoice, you receive a contract that you have to pay a certain amount within a certain period of time, like all invoices. You receive an invoice for $12,400, and it says that it must be paid within 30 days. So you see the invoice date, 30 days with an invoice, you must pay 12,400. There is no ambiguity. It's absolutely clear. The amount is clear and the timing is clear. If the amount and timing is clear, you call it a liability in your books. And because you have to pay it within 30 days, you call it a short-term liability. If you have to pay it in a period longer than 1 year, you call it non-current liability. But in any case, it is either liability, current liability, or non-current liability. Now, what happens that sometimes there are some certain situations where either this amount is not clear or the timing is not clear. So any liability which has an ambiguity about either the amount, you know that you have an obligation, you know that you have a liability, but you are not sure that how much it will be. What would be the amount? Or you are not sure about the timing, when it will be. Maybe in 3 months' time, 4 months' time, 6 months' time. So there is some uncertainty. We call it uncertain liability. And this is a situation, and uncertain liabilities, these are like the provisions are, they come under uncertain liabilities. Now, what could be the example of uncertain liability? If I give you an example, which is very basic, starting from the very simple example, at the fundamental level, we call it warranties. Warranties, these are the first example which comes to mind. Like all businesses, they sell goods on warranties. You sell, mobile phones, cell phones you sell with 1 year warranty. You know that some of the mobile phones will come back because you are giving 1 year warranty. So it's not, it's not how to say, practically possible that you say that all of the phones will remain good and nothing will come back. Maybe 1%, maybe 2%, some number of telephones will come back to you. And when they will come back, because you have signed and stamped the warranty and you have promised that if something happens, I will repair this phone for you, you know that you will have an obligation to repair it. And when you repair it, how much will be the money, how much you need to spend on that, that's not sure. You might have some estimate. Based on your past experience, you might make some estimate, but you don't have a documented evidence for that. See, for liabilities, you already have a document, you already have an invoice, you already have a contract to fulfill. But in this case, there is no fixed contract or invoice to be fulfilled. You only know that I have an obligation, I have a liability of repairing these phones, and when they will come back, I will need to repair it. I have to spend money. That's an obligation. But since the amount is not clear, so I call it uncertain liability. This is one example. The second example could be restoration cost. Restoration cost, I give you, we discussed before in past as well. When we were doing IAS 16, we said restoration cost, we add into the asset cost. I'll give you two examples, one a very small, one a larger one. The small example could be that you run an office, and a small office, 4 or 5 rooms, few hundred square meters. When you take this office on rent, probably you are paying $5,000 rent per month. You made a contract and you signed that contract, and the contract says that it is for 3 years time period or 5 years time period. After 5 years, when you will leave this premises, you will have to return it back in actual condition. And you know it today that after 5 years, after using the office for 5 years, at the end of the period, there would be expenses. maybe wallpapers would be damaged. Some of the wallpapers would be damaged by that time. Maybe some, door locks needed to be changed. Maybe some glasses or windows would be damaged. So you know that maybe you have to whitewash it, paint it or something. Maybe you have to polish the floor or something. So because you are using it for 5 years, so when you will return it back in the original condition, you definitely need to spend some money to bring it back to the original condition. But how much would be that money? It is not sure today. So that is also a provision. Number 3 example would be actually in restoration. I just gave you a small example with maybe an obligation or a liability of $5,000. And $5,000, I can bring it back in the original condition. But it could be a bigger thing. It could be in millions of dollars. Imagine that you have leased the land for 10 years time or 20 years life, and you are constructing on that land, which is a government land, which you leased it, and you have made some construction on that. Your site is there. Your operational site is there. But the contract says that 20 years later, you will return back the land in original condition. So you have to demolish the factory and you have to, move away everything from there. Decommissioning, we call it. You have to decommission the equipment. And decommissioning of equipment, it's heavy machinery. And it requires engineers, it requires labor, it requires technical expertise to move everything away. So that's also an important case. Actually, I cannot imagine a business working or operating without provision. Every business has some uncertain liabilities. It could be court cases as well, that you have some court cases which are there. You know that you will be penalized or punished or fined, but how much the decision will be, you don't know. Environmental provisionings are there. Provision for restructuring could be there. So there could be many examples of provisions. Okay. Now, the thing is that all of these examples which I discussed with you, maybe there are 1, 2, 3, 4, 5, 6, or 10 examples, maybe more. So we actually divide all of these different types of obligations into 2 categories. One category we call it provision, and the second category we call it contingent liability. Contingent liability. Now, the difference between provision and contingent liability is that provisions are those uncertain liabilities. Provisions are those certain liabilities which meet the 3 conditions and which do not meet 3 conditions. And now I'm sure that do not meet the 3 conditions. So I'm sure that you are thinking about what are those 3 conditions. So I'm repeating it again. I've got 5, 10, 20 uncertain liabilities. I group them together. Half of them would be provisions, half of them would be contingent liabilities. And how do I split them? How do I separate them? I separate them on 3 criteria. There are 3 criteria which are given by IAS 37. So any uncertain liability which fulfills those 3 criteria, we call them provision. And if any one of those criteria is missing, anyone, because all 3 is a must. If any one of those 3 criteria are missing, we call them contingent liabilities. And why do we separate them? Because their accounting treatment is different. So let's first discuss the 3 conditions. Number 1 condition, it says that it should be a present obligation as a result of past events. Present obligation means that on your reporting date, whichever is reporting date, maybe 31st December, when you are preparing the financial statements, this is already your obligation. You already have signed the contract before 31st of December. You already have given the warranty before 31st of December. So this is your present obligation. You are under this obligation already. And number 2, that it says that probable outflow of economic benefits. Probable outflow of economic benefits, which means that if in that this particular transaction would result in accounting, probable means more than 50%. It means more than 50%. That there is a 50% chance or more that as a result of this particular transaction, economic benefit will flow out of the company, which means that you will have to make some payments, which means you will have to incur some expenditure. And number 3 condition is that it should be fairly measurable. Fairly, or I would say reliable, a reliable estimate is available. Reliable estimate is available. If any one of these conditions, reliable estimate is available. If all 3 conditions are met, you call it a provision, and provisions you recognize in your books. You recognize. Recognize means that I record my expense and I record my liability, I record my provision. If any one of these 3 conditions is missing, any one of them is missing, you call it a contingent liability and you just disclose it into the books. Disclose means that I'm not putting it into my income statement as expense. I'm not putting it in my balance sheet as my obligation, but I'm putting it as additional notes and I'm informing my shareholders or the users of financial statement that this is something which may happen in future. So you should be aware of that. So you make it a disclosure note. We call it a disclosure note. Okay. Now, present obligation of why sometimes these things are missing. I said, present obligation, it has to be a present obligation, and probable outflow of economic benefit is there, which means that more than 50% chances that this thing will happen, and reliable estimate is available. Reliable estimate you make based on your past experience. I give you an example. Let's suppose that, which I said before, that you sell phones, okay? And you know that some of the phones definitely are going to come back. So you go back and you see your past record, and you see that how many of the, because I sell Samsung mobile phones, so I want to see that how much of the Samsung phones they have some defects and they come back in warranty. I find out that it's just 2%. So it means that 2 cell phones out of 100 they come back in warranty. So I expect 2% phones to come back. During the year, I sold 5,000 phones. So it means that 100 phones are expected to come back. Based on my past experience, I know that on average, each telephone repair cost me $50. So it means that for selling these 5,000 mobile phones, when you sell the 5,000 mobile phones, and you have recorded your revenue for 5,000 mobile phones, you have mentioned your cost of sales for 5,000 mobile phones, and you should also mention here your warranty expenses, and which are actually, okay, this is 5,000 mobile phones I wrote down in order not to confuse the numbers. For 5,000 mobile phone, let's suppose revenue is, I don't know, 1 million, okay, 1 million. And the cost of sale might be is, I don't know, 600,000, I wrote down. And then I need to write down my warranty expenses as $5,000. So this warranty expense has not incurred yet. It will incur in the next year, but it is my obligation as of now. And because I am showing the revenue from these 5,000 phones, I'm showing the cost of sale of these 5,000 phones, I must also be showing this warranty and repair expense, because this expense is also related to this particular item, which is here. If I don't write it down, I would be overstating the profits. Yes? So you have to be prudent. You have to be conservative, because you assume that the revenue is 1 million, cost is 0.6 million. And the question is that, is this the only cost? The answer is that this is not the only cost, because warranties may come in. So please record the warranty expense as well. So you would say debit warranty expense and credit provisions. You will not say credit cash, because you're not giving it to someone now. You're only putting it in warranty as provision, so that next year, when any mobile phone will come back in January, February, March under warranty claim, you will not be worried, because you already have provided for that before. You already have provided for that before. You are being prudent. You are not overestimating the profits or incomes. So it's very important that we put this provision into our financial statements, and this is called recognize. Recognize means that I took the expense in my income statement, debit warranty expense, and I took my provision as a liability on my balance sheet, credit provision. This is recognizing. Recognizing means putting it into the income statement and balance sheet. And how do you take anything to income statement and balance sheet? There is only one way, that you make a double entry for that. I mean, the only way of taking information or impact into ISBS, you need to have a double entry. So we make the double entry for that. So this is one simple example. Any question if you have? So 3 conditions you have here. If any of the 3 conditions are missing, now let's suppose that you said that, I have a court case, okay? I have a court case. Some of our customers, or one of our customers, who we sold some goods, and he suffered some loss, he suffered some damage because of that particular equipment which we provided him. His raw material was destroyed, and he has taken us to the court. Now, we know that the contract says that if there is any damage to you provided by the equipment, we will compensate you. So obligation is there. I know that obligation is there. I have to, because the contract says that. But the problem is on amount. And by the way, when you go to the court, it means that 2 parties do not agree, because the customer might be asking 100K in compensation. I might be offering 50K in compensation. And because we do not agree, and that's why you go to the court. If both parties agree, there is no need to go to the court. So the case is in the court. Now, I know I've got an obligation, and I know that this will happen. There will be a probable outflow because I have to pay money. But how much, that is under question. Now, if I ask my lawyer, because I don't know, so I will ask my lawyer. The lawyer says that, I have seen the documents. He has an evidence which is only for 50,000. And based on this law, based on this, particular clause of the contract or law of the land, whatever, that is the legal side of that. Lawyer says that we will be approximately paying 50K. I'm not saying exactly 50K, but approximately 50K. So I can say that there is a reliable estimate is available because it has come from an expert. The judge might decide 60K. I'm not saying it should be 100% same, but a reliable estimate is available. So I take it as my provision and I recognize. But it is also possible that the lawyer says that, Mr. Ali, you know what? I'm not sure that how much we are going to be penalized in this situation. It could be 50, it could be 100, it could be 150. Anything can happen. It will depend on the court. So I asked him that, see, this is 31st of December. I am preparing my income statement and balance sheet. And income statement, balance sheet, I have to put the reliable numbers. Tell me, what do I write? 50, 100, or 150? What should I write? And he says that, you know what? I can't say. I can't say it. We have to wait. I say, okay, if you don't have any number, then I will not put it. Very simple. Because I can't put wrong numbers, knowingly wrong numbers, I cannot put into my financials. So then I disclose it. Disclose means that I am not making a double entry on 31st December. I am not saying debit legal expenses credit provision. If I have a reliable estimate on 31st December, I would say debit my legal expenses or sometime admin expenses and credit provision, whatever. I have not paid it, but I just booked the expense and booked the liability. Booking the expense and booking the liability. If estimate is there. If estimate is not there, because every double entry needs a number, and number I don't have. So if I don't have a number, I will decide to disclose. Disclose means I'm not taking it to the income statement. I'm not taking it to the balance sheet, but I'm putting it as additional notes to the financial statement. I'm making a disclosure that there is a court case going on. This is the customer, this is the situation, this is the possible probable outcome. But because we do not have numbers, so we didn't put it into the financial statements. But you guys, the users of the financial statements, the shareholders, should have knowledge that this is something which could happen in the next year. So that when next year the court case will be announced, decision will be announced, my shareholders do not be surprised. They don't come and ask me that, Mr. Ali, what is this? You never told us about this. We never knew that there is a court case. So I am providing you information. Because I do not have correct numbers, so I didn't put it in my income statement or balance sheet, but otherwise I'm giving you information. So I can provide you information either through IAS or BS or through the notes. In this case, I'm providing you information through the notes. So these are the three conditions which must be met. And in the absence of any condition, we call it a contingent liability. And contingent liabilities are disclosed. Any question until here, if you have, please ask. Then we have a contingent. After contingent liability, we also have contingent asset. Contingent asset. Now, contingent asset is a possible asset as a result of past events, Now, imagine this equipment, which I sold to my customer and which has created this problem, and the customer has taken me to the court. This equipment, I did not make it at home. I actually purchased it from my supplier. I also have a supplier at my back. I purchased this equipment from Mr. X. So when all this trouble started, I called Mr. X. That Mr. X, see, this is the problem. I purchased equipment from you. I sold it to my customer. Customer has suffered loss. Customer is taking me to the court, but you have a responsibility because I have a contract with him. The contract which I made with my customer, a very similar contract I made with my supplier, that if there is any loss, you will face. And maybe I have a court case against my supplier as well. So my customer takes me to the court, and I take my supplier to the court. And if the court decides that my supplier, Mr. X, should compensate me, then this immediately becomes my receivable. This is my asset. If only the court gives this order that Mr. X should compensate Mr. Ali for this loss, the day this decision will be announced, this becomes my receivable, and I start knocking his door with the court order. You owe me money. This is the court order. So it is a possible asset as a result of past event. Now, there is one thing which is very interesting. If you remember, okay, so what are the conditions? What are the conditions of this contingent asset? Contingent asset, again, the condition is that it is a possible asset as a result of past event. And number two, that it, inflow. Now that's interesting, of economic benefits. And you need to pay attention, is virtually certain. Here, the terminology has changed. Virtually certain. You see, when I was doing provisions, in provisions, I said that it is probable that there is an outflow of economic benefit. I use the word probable. Probable means more than 50% chance. If there is a 50%, 51% probability that you will have to pay, you recognize it. Liability, you recognize with 50% chance. 50% chance that court will decide against me, I immediately say, oh, it is my liability. But in case of an asset, you have to be virtually certain. Virtually certain means more than 90% probability. Now that's, you see, again, prudence concept has applied here. The concept of prudence, conservatism, that liabilities, even if it is 50% chance, I take it as my liability. If the court says, no, you don't have to pay, I will be happy. But I initially record it as my liability. And if I don't have to pay, I can remove it. But in case of assets, you only recognize your contingent asset when it is virtually certain. Virtually certain means more than 90% possibility is there. And this is done because so that you don't start, recording false assets. Because if I record asset at 50% and tomorrow the court case comes against me, then removing it from the balance sheet will be very difficult. Because on 31st December, I tell to my shareholders that this is an asset which you will receive. And in January, the court case comes against me. How can I go to my shareholders and tell them that I'm sorry, please remove this asset from the balance sheet? This is not going to happen because removing assets from the balance sheet is really a tough thing. Taking them to the balance sheet is easy. Removing from balance sheet is difficult. And you have to be prudent. You can't overestimate the assets. Remember, income and expenses are always estimated at the lowest value. Expenses and liabilities at the highest value. So I would only recognize asset when it is 90% virtually certain. 90% is the probability, and which means that it is virtually certain. So this is like the basics of provision. And then you record the double entry, debit this expense, and credit, whatever your provisions or etc. So now we understand that what is an uncertain liability. We understand what are the types of uncertain liabilities. We understood already that what are the three conditions. And then based on the three conditions, we understand the difference between provision, which meets the three criteria, contingent liability, we disclose it does not meet the three criteria, and contingent asset is our possible assets. Any questions until here, please ask me. Okay, so one thing I just wanted to say that
one more thing. When you told about more than 90% of
contingent assets, if there are 90%, more than 90%, which means virtually certain. Virtually certain you recognize. Recognize means that you take it into the balance sheet.
Okay.
But if it is probable, which means that it is less than 90%, it is 50, 60 or something, then you disclose it. Just like you disclose your contingent liabilities. So contingent assets also have two things, recognition and disclosure. Recognition will happen with virtually certain, which means plus 90% probability, and less than 90% probability, will be disclosed. Okay. Now, one thing which you asked during the break, or the question, I just wanted to repeat it again and sum it up here. What are not provisions? What are not provisions? For example, sometimes, and this is actually in real life, it happens, and it happens in exam questions as well, because that's a very practically realistic scenario. Sometimes you have major overhauls in your equipment. I call it major overhaul. What happens when you have repair and maintenance? Repair and maintenance is a routine thing, generally not very expensive. It goes to P&L, and that is your expense out you do it. Sometimes you have major overhauls, significant amount of money is spent on equipment, and it is planned. You already know that your asset, you start using it here, after 5,000 hours of operations or after 2 years, whatever. It will require a major overhaul of $2 million. So should we create provision for that or not? Because we know that exactly after 2 years, I will have to stop and I will have to spend 2 million or 3 million, whatever. So is it my liability? Always remember, because there are some other situations as well, which I'm going to give you example. Because students they think that, is it my provision or not? The provision thing, it starts with uncertain liability. The word which comes to your mind is a liability. Okay, focus is here, liability, obligation. Doing major overhaul or minor overhaul or whatever, it is your choice. It is not your liability. It is not your obligation, because this is your equipment. Yes, if it is someone else's equipment and you are obliged to repair it, that is some, like, I took an office on rent, and they say when you will leave, you will have to repair it. Now that is a liability, because the asset does not belong to me. I'm using it, and I promise them that after using, I will repair it. That is a provision. But if I am the owner of the asset, if the asset belongs to me, then doing repair is not an obligation, because I may repair it, I may not repair it, or I may sell it, I may not continue to use it. It's my choice. It's not an obligation. Nobody can force me. Nobody can take me to the court. When I take an office on rent, and if I do not repair it at the end of the lease period, they can take me to the court. I have a liability against them. But if it is my asset, it is my choice. Nobody can force me to repair it. Okay. So that is not major overhaul, is not a case of provision, not at all. Second example is, we talked about when we were doing IFRS 15, and we said that sometimes goods are returned back. Okay. Goods are returned back. We call it refund liability. Okay, refund liability. Refund liability, that is a case of provision. So you create provisions for refund liability. Why? Because number one, you have a contractual obligation that if these goods will not be sold, I will take them back. So obligation is there, and it's a liability, and my customer can force me to take it back. And second is that amount is not clear, because I have supplied him goods for $100,000. I don't know how much will come back. Maybe 2K worth of goods will come back. Maybe 3K worth of goods come back. It is not clear now. It is not written that exactly this much of goods will come back. If I know exactly how much goods will come back, and if I know exactly how much money I have to give, if it is exact, then it is certain, then it is liability. Because these amounts are not clear, we call them, the obligation is there, but it is an uncertain obligation. And therefore we create provisions for that. So for refund liabilities, you create provisions. For major overhaul, there is no concept of this provision.